If you do any business with the government, then you absolutely have to know about something called GST TDS. Now, I know it can sound a little complicated, but trust me, we're going to break it all down for you right now. Let's get into it.
So when you hear the acronym TDS, your mind probably jumps straight to income tax, right? But did you know there's a completely different TDS that lives in the world of GST? It's a super common mix-up, but believe me, they are not the same thing at all.
And here's the fundamental difference, the thing you really need to get. Income tax, TDS, that's an advanced tax on your earnings. But GST TDS, well, it isn't an extra tax. Not at all. Think of it more like a clever tracking system the government uses to keep an eye on big transactions and, stop any tax leakage.
Okay, so now that we've cleared that up, let's dive into the basics. What exactly is GST TDS? And more importantly, who really needs to pay attention to it?
So, in a nutshell, it's pretty simple. Certain specific organizations have to snip off a tiny percentage of the payment they're making to a supplier and send that little piece directly to the government. It's a way to monitor the cash flow and make sure everyone's staying compliant, especially on those high-value government contracts.
So, who are these certain organizations? Well, we're talking about the big players, central and state government departments, your local city municipality, government agencies, and those big public sector undertakings, or PSUs. The main takeaway here is this. If you're supplying goods or services to a government-related body, your ears should be perking up right now.
All right, we know who's doing the deducting. But when does this rule actually kick in? Let's get into the nitty-gritty of what triggers a GST TDS deduction.
This right here is the first magic number you need to remember. GST TDS only comes into play if the total value of the goods or services under one single contract is more than 2.5 lakh rupees. And a really important detail here, this applies to the entire contract value once you cross that line, not just the amount over 2.5 lakh.
And the second magic number? The rate. It's a nice, flat 2%. So if the transaction happens within the same state, that 2% gets split. 1% for central GST and 1% for state GST. If it's between two different states, it's just a straight 2% for integrated GST. See? Simple.
Finally, you've got the deadline. The entity that deducted the tax has to deposit it with the government and file a special return called GSTR-7 by the 10th of the very next month. This step is absolutely essential for the whole process to work.
Okay, all that theory is one thing, but nothing beats a real-world example to make it all click. So let's walk through a quick scenario, step by step.
All right, picture this. You're a vendor. You've done some great work for a PSU, and your invoice, before GST, comes to 3 lakh rupees. Now, since that's clearly over the 2.5 lakh threshold, the GST TDS rules are officially in play.
So, before the PSU wires you the money, they do a quick calculation. They take 2% of that 3 lakh value, which works out to be 6,000 rupees. They hold on to that amount for a moment.
Then the PSU pays you what's left over, 2,94,000 rupees. So your invoice was for 3 lakh, but this is the number that actually shows up in your bank account.
And right about now, you're probably thinking, hey, wait a minute, where's my 6 grand? Well, don't panic, it's not gone. The PSU has paid it to the government on your behalf, and it's basically sitting in your GST account, just waiting for you to claim it.
Which brings us to what is maybe the most important part of this whole thing for any supplier. How do you actually get that money back and put it to use?
Okay, listen up because this part is critical. After the PSU files their GSTR-7 return, that 6,000 rupees will magically appear in your GST portal. But, and this is a big but, it doesn't automatically become yours to use. You have to take action. You have to physically log in, navigate to the TDS Credit Received tab, and click Accept. It's only after you do that that the money moves into your electronic cash ledger, where it becomes as good as cash for paying off your future GST bills.
And for your records, you'll also get an official certificate, which is Form GSTR-7 as proof that the tax was deducted and paid correctly.
Now, this whole system is really a two-way street. The government entity faces some pretty serious penalties if they don't follow the rules. But as the supplier, it's really on you to make sure you're doing your part.
I mean, just look at this table. The consequences for the deductor are no joke. We're talking interest, penalties, late fees, even prosecution for fraud. The government is serious about this. But for you, the supplier, the biggest pitfall is just forgetting about it. If you don't track these deductions and claim your credit, you're literally just leaving your own money on the table.
And this quote really sums it all up, doesn't it? When the deductor does their job on time and the supplier accepts the credit promptly, the whole system works exactly as it's supposed to. It's all about diligence from both sides to keep things running smoothly.
So, let's do a quick-fire recap. 1. GST TDS is a tracking tool, not an extra tax. 2. It applies to government contracts over 2.5 lakhs. 3. The rate is a simple 2%. And 4, and this is the big one, as the supplier, you have to log in and accept the credit online. It's your money. Make sure you claim it. Which leaves me with one final, very practical question for you. If you're doing business with the government, be honest. When was the last time you checked that TDS/TCS credit receive tab? Because if it's been a while, there might just be some money sitting in there with your name on it. Go have a look.